Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. Quick reminder of our overall philosophy at Trading University. The pattern on the chart is a reflection of the market's underlying fundamentals. First market we're going to cover, as always, is the Australian US dollar. Aussie US dollar recovered a pretty nice recovery late last week. This is a daily chart, and you can really see the extent of that big sell-off. We pretty much had anticipated that. We were saying all along 80 was our downside target. You got very close to 80. One reason 80 was our downside target is we had a lot of support just below that level. We thought 80 or so was not a bad time to actually take a look at that value down there and even go in on longer term dollar cost average just below 80. You didn't quite get there. Interesting pattern, however, here on the weekly. There you see that nice big turnaround on the weekly too. So for all practical purposes, if we go after the Aussie on the short term, it would be more or less as intraday traders back out to that monthly chart. We think you do have real support down there. We think longer term, accumulating that market just below the 80 level, not a bad way to go. We referred to last weekend, we said, you may be close price-wise to a time for that market to start to bottom out a bit, but time-wise, we think it may still have a ways to go. That's why we like the dollar cost average strategy. Time-wise, we think there's a lot more U.S. dollar strength ahead, and that'll continue to depress this market. Nonetheless, we're really not interested in going after this market on the downside longer term here. We think that you have pretty good support there down to from just below 80 down to into the 77 handle. So that'll be an area we'll watch for a potential shift in momentum and an actual turnaround in this market. So we think again, time-wise, you may not be so close to a bottom, but price-wise, you're getting there. We don't see a whole lot more downside for the Aussie. Next market, dollar Swiss. Quite the opposite analysis here. We think there's plenty of room on the upside for the dollar Swiss. There's a monthly chart. Look at all that room up above. You see some lines on the chart. That's very definitely resistance. Here we'll drop down to a weekly. You can see that potential resistance right there. The market's come a long ways. It looks like exhaustive momentum there too. So wouldn't surprise us if you do get a little bit of a short-term turnaround here. We still like it long-term on the upside. As I said, looking at that monthly or just scrunch up the weekly chart, we think there's plenty of room up above, but you've got to clear that resistance. Par back down a weekly chart. Par was our upside target for a long time. That's 100, and it got to par. And as markets often do with the momentum, it jumped it, kept going. But we think potentially you're at an area where you take some off the table, you put some in your pocket there longer term because you're at potential resistance. And let's face it, the same economic determinants that have helped the U.S. economy in place the last couple of years, that is going back, the quantitative easing, and now the effects of that, where the consumers they're able to refinance purchases at lower levels, particularly their homes, obviously, and now you got the bonus of the lower energy prices. You're going to start to see those same components interacting around the globe. The ECB is going to go with that quantitative easing route, and the globe is going to benefit from lower oil prices. There's more plus there than there is negative, and that's not going away, those lower energy prices, for a long time now. So you'll see Europe start to pick up. You'll see business around the globe start to pick up. We think the U.S. will still continue to lead, and you'll still see predominant U.S. dollar strength. But so much of that disparity, where you have a terrible European economic number at 5 a.m. Eastern Standard Time, and then 4 hours later you have a bang up. You have a great U.S. economic number. I don't think you'll see that disparity between the economic numbers much. I think that'll start to close, and likewise the momentum of the U.S. dollar rally will will start to wane a little bit. Speaking of the U.S. dollar rally, here it is coming up. The dollar index. At resistance also. That's the O pan out to monthly. You're at the 06 high there. So market's stalling at the 06 high. Natural area for longer term bulls to take some money off of the table. Market's reaching a lot of analysts upside, their nearer term upside target. Drop down to a weekly, drop down to a daily. You'll start to see the market does look a little bit extended there. There it is on the weekly. So a natural point for the market. There's previous resistance. You took that out. I think that was the 09 high. So U.S. dollar, probably in a position here to take a breather. Long term, though, we still think plenty of room on the upside, but no surprise if this massive bull that we've been cheerleading the whole way up starts to pause. And I'm gonna get to the notes in a little bit. First, we'll cover the currencies, but you're gonna see what will propel that next leg up in the dollar, and we'll get to that in a second. Here's the euro. I still think there's plenty of downside in the euro. When you look at the euro, it's still trading above par to the dollar. We think, overall, you'll see that relationship shift to below par. Right now, par being a good ways up here at 118, so we still think there's a long way to go. You're seeing closes below that 50% retracement of this massive move. So if you retraced over 50% of the big rally in the previous decade, and we think that's a sign that you'll continue to retrace that. So longer term, plenty of room on the downside for the euro. Shorter term, however, you're probably a little bit overcooked there. But we'll show you our shorter term trades for the week and why we think you need to stay on that dollar. Stay on your long dollar position. Short term, stay focused on selling rallies in the euro short term also. And here's how we did for the week. You only had 4 trades, not a whole lot of trades out there. All of them happen to be winners. Keep in mind, when you see these here, the first trade, that's a 40 tick winner. The second trade, 58 tick winner. Third trade, 100 tick winner. What I want you to focus on is that in order to take out a 40 tick winner, basically $400, you had to be willing to risk $270 or so. So in order to get that 400, you got to be willing to risk the $240, right? In order to take, to collect that $1,000 here on a short euro trade, you need to have been willing to risk $660. So the 2 points I want to make here when it comes to showing, we had 4 profitable trades into the new year. Last week we had only 3 trades, not a lot. Nonetheless, they're winners. That's a good thing. But again, in order to make that money, cumulative year to date, $2,540, you had to be willing to risk 60-70% of that, right? Also, when you're looking at these trades, we're keeping the method simple. We're just giving you the entry and the exit. Normally, we teach our students, hey, if you put 2 on, take 1 off at a percentage of the risk on the trade. Let the other one go. We're not letting the second half of that position ride. So we're not letting winners ride here. All we're doing is showing you where to get in, where to get out on that first tranche, just to keep it simple. So we'll say both of them. So that's to keep in mind here. Number one, if we say we make $400 on a 2 lot, that meant we were willing to risk $260, $270 to do that. You got to have the money to make the money. And also, we're not letting profits run here. So you're going to be looking at a pretty much 1.5 risk reward. So, hey, good week for the method. Not a lot of trades, but quality over quantity. That's for sure. So we think the euro's got a lot more downside here longer term. Shorter term, maybe a little bit overcooked on the downside. Next market, the gold market. We've been saying for some time now that we think you're looking at a bit of a dead cat bounce here. Here's gold longer term. You take a look at it on the weekly. Scrunch that up. You found good support right at a 625, right at the old GAN 625 level. Market stabilized all the way back in November. And, you're continuing to see a little bit of upside. Markets creeping higher. Let's look at the daily. We're hoping they could squeeze another rally out of that guy. In a perfect world, you'll actually, you can run sell stops at these levels between 1250 and 1260. Run those stops, get that market up in the 1280. and maybe even a push on 1300, and then that'd be an excellent area to set up shorts in this market. We think you're just looking at a dead cat bounce here. Pop out to the monthly. It's pretty easy to see that you have your most recent pattern here over the last few years has been one of lower highs and lower lows, and we think that's going to continue. So we're pretty beared up on gold. Let me show you the 10-year note market real quick, and this is why we feel pretty strongly you're going to see another leg down for the euro, another big leg up for the US dollar, another leg down for gold. Here's a monthly chart of the 10-year note futures. This is interest rates in the United States. As the 10-year notes go up, interest rates go down. The reason the U.S. dollar had been so weak looking back over the previous decade is because interest rates continued to go lower and lower. So as rates went lower, the U.S. currency got weaker and weaker. Now, what's happened in the last couple of years is interest rates, we feel, have finally bottomed out. The 10-year note finally topped out. So you're seeing the beginning of higher interest rates. That's what's leading to dollar strength right here. Probably be easier if I show you interest rates themselves. Here they are. Here's the interest rates themselves. So what happened in the last couple of years is interest rates finally bottomed out just above 1.25 for the 10-year note. They actually bounced all the way up to 3% for the notes, and now they came back down, and they're carving out a bottom here. As they carve out a bottom, basically as rates rise, so too will the U.S. dollar. So you saw a lot of dollar strength lately, and frankly, interest rates haven't even kicked in. You have what could be the first higher low here. And what do you think you get following a higher low? You get a higher high, and that fans is what we call market reversal. So potential market reversal in the 10-year notes, meaning higher interest rates in the U.S., and we think that's what's going to be the fuel to see that dollar go a lot higher against the euro, against the Swiss franc, not necessarily against the Aussie. We think that guy's bottoming out, but you'll see some spikes lower in that Aussie when you do get the turn here in interest rates. So that's really what you have to keep your eye on. We think that's what's going to propel the dollar higher still, but short term, you're probably in for a bit of a consolidation in here. And we don't mind that because we're short-term traders. That's what we focus on mainly. I teach in live markets, and I prefer those lower time frames. But from an investor standpoint, we think it's essentially happening. You follow what's happening on the higher time frame charts. A great example of that would be back to the Swiss franc on the monthly. Look at all the upside on that if you're an investor. There you go. Thank you so much. Again, my name is Jay Norris, and I teach at Trading University, and we'll see you next time.